Welcome to the debate. So today we're diving into quite a profound way of looking at Bitcoin. It's this idea, framed really clearly by Booth, that we should see it not just as, another speculative crypto asset, but as something fundamentally different, a foundational protocol for global finance. And this view really separates it sharply from the rest of the quote-unquote crypto space.
Right.
And the question that naturally flows from that, the one we're tackling today, is whether Bitcoin's specific design choices, its deep commitment to security and decentralization above all else, basically guarantees it'll win out in the long run, like a single winner-take-all base financial layer. So we're debating the idea that structurally, all the other competing blockchains, they're essentially destined to fail, to become obsolete. My position is, yeah, that structural supremacy is pretty much inevitable based on how these protocols work and the unavoidable trade-offs of the blockchain trilemma.
Yeah, and I'm coming at this from a slightly different angle. While I absolutely agree that prioritizing security and decentralization is, well, critical for any kind of global monetary base layer, I really push back on applying that winner-take-all idea quite so rigidly, especially when you're trying to map it directly from, say, internet protocols like TCP/IP onto something as messy and frankly specialized as global finance. And I also seriously question this sort of absolute certainty that all other chains will just collapse, go to zero, even the ones that might have made, rational trade-offs for specific functions or scale.
Okay. I see why you might focus on that, the sort of immediate functional needs. But let me offer a different perspective, maybe one grounded more in long-term economics and even physics. Booth really emphasizes that the natural tendency of a truly free market, one driven by efficiency gains from technology, is deflationary, whereas our current fiat system, it relies on constant central bank expansion, inflationary policies. It actively fights against that natural state. Bitcoin, structurally, is the only digital system that aligns with that natural deflationary pull. The key insight here is really definitional. Bitcoin isn't just code. It's an open, permissionless, secure protocol, and critically, it's bounded by real-world energy consumption through proof of work. That energy link makes it incredibly expensive to forge, economically speaking, and that's what fundamentally separates it from so many other cryptos. Those often involve, manipulating token supplies, relying on centralized groups, or having security models that are frankly much weaker. If you look at the history of foundational protocols, TCP/IP is the classic example, but even HTTP, when a superior, open, decentralized base layer emerges, it tends to dominate. It captures the network effects, absorbs value, and the closed or centralized alternatives, they tend to fade away. Bitcoin made that hard choice with the blockchain trilemma, security and decentralization first, even if it meant sacrificing raw speed on the base layer, that famous, 5-7 transactions per second limit. But that uncompromised foundation, that's its strength. It's what makes it resilient.
And the consequences, Booth argues, is that pretty much all other coins, because they lack that specific combination of energy-backed immutability and genuine decentralization, well, they're structurally flawed and ultimately likely headed towards zero.
Right. That's a compelling case for the base layer's integrity. Though I guess I'd frame the outcome of that trilemma choice a bit differently. I completely agree. Prioritizing security and decentralization is the only way to build a truly trustless global money. No argument there. However, the leap to saying all other chains will inevitably collapse, that feels like it leans too heavily on forcing that winner-take-all analogy from internet infrastructure directly onto finance. And financial systems, well, they're just inherently more complex, more varied, more specialized than basic information routing, aren't they?
Debatable maybe.
Well, think about the immediate sacrifice of scalability. It's huge. To get practical use, Bitcoin has to rely on these other layers you mentioned. Lightning for small payments, Liquid for faster, sort of federated settlement, Nostr for applications perhaps. Now this reliance, it introduces its own structural complexities, maybe even new vectors of trust or failure that weren't really present in those pure non-custodial internet protocols like TCP/IP. The source material itself acknowledges that other big projects, like Ethereum, explicitly chose a different path prioritizing scalability and complexity. even if it meant compromising on pure decentralization, like moving to proof of stake. So I'm just not convinced that labeling them centralized or speculative automatically guarantees they go extinct, especially if the market finds real utility in specialized functions or needs that immediate scale the Bitcoin base layer, by its very design, struggles to provide directly.
I appreciate you highlighting the specialization in finance, but doesn't this just bring us back to the core protocol analogy? I mean, why should we assume the fundamental rules of network dominance suddenly change just because the thing being transferred is financial value instead of data packets? Protocols gain dominance because their openness, their robustness, their security makes them the most reliable foundation to build on. Just like TCP/IP became the default way to route information globally, the argument is that Bitcoin will do the same for routing, storing, and settling monetary value. The distinction is foundational. Bitcoin aims to be that open, permissionless protocol layer. Many others, as Booth points out, often operate more like, well, manipulative projects. They can end up replicating the same old problems of the fiat system, the zero-sum dynamics, the need for trusted third parties. Okay, that's a strong case for Bitcoin as the ultimate secure monetary base, I grant you that. But have you maybe considered that financial systems, just by their nature, almost never rely on one single monolithic standard for absolutely everything? I mean, even today, underneath the internet protocols we use, we have a whole zoo of competing specialized standards, right? For credit card processing, for cross-border bank messages like SWIFT, for settling securities, for high-frequency trading platforms. These are all effectively ledgers, but they serve very specific, often high-volume needs. So if Bitcoin's base layer is laser-focused on being the most secure, the hardest store of value, the ultimate settlement layer, isn't it plausible that there remains a significant, maybe even permanent need for other, more specialized, maybe much higher throughput protocols, even if they are comparatively less decentralized?
They might handle specific industrial uses, high-frequency stuff, or localized financial tasks. Maybe they don't even try to be global money, but just specialized transaction systems. Are we absolutely sure that the foundational layer of global finance must be singularly exclusive, unlike, say, the operational diversity we see in almost every other major infrastructure? And let's really focus on the concrete trade-offs of that blockchain trilemma choice. Okay, yes, Bitcoin sacrifices scalability on the base layer, pushing complexity up to secondary layers. Let's look at the functional reality there. If some other project makes a different choice, maybe sacrifices some decentralization, perhaps going from, I don't know, hundreds of thousands of nodes down to a few thousand validators, or using a federation like Liquid does, and in doing so, it becomes demonstrably super effective at a specific high-volume job. Why must it absolutely go to zero?
It might be, effectively centralized compared to Bitcoin, sure. But does that partial centralization guarantee its doom if it offers a type of functionality or speed that the pure trustless base layer simply can't deliver because of its inherent transaction limits? I worry that the winner-take-all view might be overlooking this kind of utility-driven persistence.
See, I'm just not convinced by that line of reasoning because I think you're potentially confusing short-term utility with long-term durability. The moment you compromise on decentralization, you are fundamentally compromising the entire point of a permissionless financial system. Boots is quite clear on this. Centralized systems are inherently vulnerable. They can be captured, manipulated, censored, which makes them ultimately unsustainable, especially when dealing with value over the long term. If a project gives up that core decentralization, it essentially breaks the promise of being a durable global base layer. It starts to look more like the fiat system again, with its distortions and single points of failure. We have to ask, what's the real security model protecting those specialized ledgers you mentioned?
If they aren't anchored in something like proof of work, with open verification by anyone, they inherently reintroduce reliance on trusted intermediaries, accountable parties. That just pushes us back towards the flawed zero-sum system we're trying to escape. The real solution, the argument goes, is to build that scaling capability resiliently on layers like Lightning, which is designed to be non-custodial and inherit the base layer's security, not to compromise the foundation itself just for quicker transactions today.
But okay, let's look closer at that idea of inheriting security. What does that actually mean for the average person using something like Lightning? It often means dealing with the complexities of opening channels, managing liquidity. While it's technically brilliant, it does introduce new practical considerations, maybe even implicit trust assumptions about your channel partners, about finding a route for your payment. even just having the technical skill to manage it properly. And if a user, for simplicity's sake, ends up relying on a third-party wallet or a custodial service to handle their Lightning channels, which, let's be honest, many probably will, aren't we kind of reintroducing a degree of trust and centralization right there at the functional layer?
That functional compromise, sacrificing perfect trust minimization, is arguably what enables to scale on L2.
So if a competitor chain is just upfront about being slightly centralized, but offers, I don't know, millions of transactions per second for some specific institutional settlement purpose, couldn't the market decide that functional trade-off is acceptable, maybe even preferable to the complexities or current limitations of L2 solutions?
Well, you're focusing there on the, let's say, the architectural trade-offs needed for scaling, maybe even user choices, not the fundamental integrity of the protocol itself. The fact that custodial solutions might exist on Lightning, that's arguably a user choice or a market development, not a flaw in the protocol's design. The core option for trustless, non-custodial use is still there, and it's ultimately secured by that energy-intensive base layer. Compare that to a chain that is structurally centralized right at layer 1. It offers no escape hatch, no option to bypass reliance on its designated validator set or its governance council. That fundamental structural difference, that's the core of the assessment Booth is making as I read it, and the material is pretty explicit here. The prediction is that over time, all these other coins will trend towards zero. This isn't presented as, just market speculation or investment advice. It's framed as a structural assessment rooted in the physics, the economics of the protocol design itself. It flows directly from understanding the trilemma and the historical pattern of winner-take-all dynamics in foundational protocols. When you look at the competitors, they fundamentally lack that energy bond of proof of work, which is the ultimate guarantee of economic security and resistance to change, that immutability. Consequently, they remain vulnerable to inflationary pressures, to regulatory capture, to governance failures, essentially. Vulnerable in ways similar to the fiat system itself. They simply aren't designed as sound financial protocols from the ground up. And this perspective helps explain, I think, that cognitive dissonance Booth describes experiencing when first grappling with Bitcoin. It forces you to confront this uncomfortable idea that maybe the zero-sum fiat game is unsustainable, and many of the crypto alternatives just end up replicating its core flaws in new packaging.
Look, I'm sorry, but I just don't quite buy that level of absolute certainty, zero value for all competitors. Let me explain why. While I totally concede that, yes, the vast majority of alt projects probably lack the economic soundness, the security, the genuine decentralization of Bitcoin, and yeah, many or most will likely fail. Claiming that every single one is destined for zero, that seems to require assuming that the trilemma constraint is an absolute insurmountable barrier in every possible financial or even utility context, forever. It kind of overlooks the possibility that pure utility might sustain some value, even in a system that isn't trying to be global money. Think about maybe a permissioned corporate blockchain used just for internal supply chain tracking. Maybe speed and low cost, which are easier with centralization, are way more important to those users than absolute global permissionlessness. While Bitcoin's position as the secure monetary base looks incredibly strong, maybe overwhelmingly so, predicting zero value for every single alternative feels, well, it feels less like pure protocol analysis and maybe a bit more like a philosophical commitment needed to make that winner-take-all analogy stick completely. Utility and network effects, they can be sticky things, even if the underlying protocol isn't perfect for every use case, especially the monetary one.
So, for me, my position really stands on the evidence of structural integrity. Bitcoin's deliberate, uncompromised choice for security and decentralization aligns it with what Booth sees as the natural, deflationary state of free markets. It aims to fix the distortions built into the fiat system. And this structural purity, when you combine it with the historical pattern of winner-take-all dynamics for foundational digital protocols, it really does point towards Bitcoin having a unique destiny as the sole enduring base layer for value. Competitors, because they either can't or won't maintain that same structural purity, they are, from this perspective, fundamentally unsound.
They're likely to break under sufficient economic or regulatory pressure over time.
And while I absolutely acknowledge the, let's call it, architectural superiority of Bitcoin's focus on security and decentralization, especially for that critical role of a global monetary base, I guess I remain cautious about declaring the inevitable absolute failure of all other chains. The jump from purely information protocols like TCP/IP to the really complex, layered world of finance, it introduces necessary trade-offs, particularly around specialized, high-volume transactions. And those trade-offs might just allow some utility-focused alternatives, even ones with acknowledged governance compromises, to find a niche and persist alongside the secure base layer.
So we've definitely examined some profound implications today, looking at Bitcoin through this lens of protocol design, the hard constraints of the blockchain trilemma. We've explored the very strong case for its potential singular supremacy.
And also, I think, some credible arguments for why that supremacy might not be quite so absolute or exclusive across all possible applications in the financial world. We're really left wrestling with whether the complex needs of global finance will follow the exact same winner-take-all rules as the early internet did, and what the true cost and benefit of that absolute structural purity means for the entire financial system stack. Clearly, there's a lot more to dig into in this material regarding how all these layers might actually interact in the future.